Which following associations of two individuals most likely is a partnership? A pair that owns land with through a tendency in common, with the co-owners sharing all profits made through use of the property. What do you think?
I think it's like it's rent-ish, and that is not,
It is rent.
so it's not.
I don't know. Or Sydney, a pair they intended together as partners to carry on business for profit. It seems like to me that's a classic definition of a partnership. Or C, an employee share in gross revenues with the profits received in payment of wages. Jody?
No.
No, I don't think so. Or an agent shares in the profits of the principal but not the losses. You know, that's a good deal. If you can and Cindy, do you think that would be a common deal? I appoint you as my agent to go out and transact business for me, and I agree to pay you a salary or commission and share the profits, but if we suffer a loss, you don't share in that. That seems like a common, but that doesn't make us partners, does it?
No.
So it seems like, Sydney, A is a possibility, although Jody doesn't like it, but B is a much better answer. Therefore, the answer is B. Jody, you agree?
Yes.
Question number 2. Under the Revised Uniform Partnership Act, Kayla, which of the following have the right to inspect partnership books and records? Would the employee? And here's the thing, Kayla, as I look at this, oh, there you go.
Yeah.
As I look at you're wearing red, and so you kind of blend in with David there.
Matching hair too.
Say that louder, sir.
Okay.
David's hair also matches Kayla's, although Kayla's shorter. As I'm looking at this question, I'm thinking that the answer is going to be partners. But then, as I look for that, I find that that's not an option. So let's look at the possible answers. Employees, what do you think, Kayla? No, I don't want my employees looking at my records. Cindy, if they looked at my records, they would ask for a pay raise. Or B, former partners. Or C, inactive partners. Kayla, what's an inactive partner? A partner that's not active. For example, it could be, Linda, that an inactive partner may be the money person while Linda runs the business. So Linda is actively involved. So that's a possibility. Or Megan, a transferee is a partner's interest. Oh, Megan's not here. Or Kayla, a transferee of partner's interest. Which is the better answer? Kayla? Inactive partner C. Sydney, you agree? Question number 3. Ann and Katie. Which of the following, Katie, is true with regards to fiduciary duties? Tell me again what a fiduciary duty is.
Like what? Expected loyalty.
Loyalty, I have to keep your best interest at heart, and I can't be self-serving, and so forth. The partnership agreement may eliminate a partner's fiduciary duties. I think, Katie, whenever we see a all or nothing, and elimination seems like an all or nothing, that probably is not the right answer. Or the partnership agreement may eliminate the right of the court to expel a partner. Well, Katie, that doesn't make sense. Can you and I make an agreement that will tell the court what it cannot do?
No.
I mean, it's going to say,
Do what it wants.
so B cannot be right. A partnership agreement may establish standards for measuring performance of fiduciary duties, or the partnership agreement may reduce a partnership's fiduciary duty below gross negligence. So I think A is wrong. I think B is wrong. So therefore I'm left with C and D. But it seems like to reduce the standard below gross negligence is really low. So, and the answer is C. Katie, you agree?
Yes.
C for Katie. Question number 4. Talini, a general partnership must pay federal income tax. Well, Talini, you learned in advanced tax, that's wrong. Brandon had 2 or more partners. I think, Brandon, that's the definition of a partnership. Have written articles of partnership. Talini, we suggested last time that we should have a written partnership agreement, but it's not required. In fact, many partnerships don't. Provide for apportionment of liabilities for partnership debts. We should do that, Brandon, but do we have to?
No.
Therefore, Talini, the answer is B.
I think you missed the 4th one.
Oh, I'm sorry. I'm sorry. Well, let me do 5 then. I'm sorry, thank you.
Oh, you're on the right
You just
one.
did.
I know, but I want to do 5. Where did 5 go? Okay, so the answer to number 5 is
B.
B. Very good. I was impressed with that. Now the answer to number 4 is And Talini, you said, let me make sure I understood what you said. You said you think I skipped number 4? You think I skipped number 4? Angela has it on tape. I skipped number 4. I think that's your way of being polite. Okay, number 4, Linda. Well, Linda wasn't even paying attention enough to know that I did it. Linda, we have Ellen Ford and Orange do business as virtual associates in general partnership. A third party brought a breach of contract suit against the partnership and one of the partners individually. Third party won the suit and filed a judgment against both partners in the partnership. Trent will generally be liable to collect the judgment from. One of the things that we know, David, is with a partnership you do not have unlimited liability. You have unlimited liability with a corporation, but you don't have one with a partnership. So, I think with that in mind, I think I can eliminate A and D automatically, because Linda A says only, and D says only, and it doesn't. And if Linda, if A was correct, then we would have limited liability, which we don't. And also, what's wrong with D, David?
The suit was also brought against the partner.
Yeah, that is, my personal assets are at risk, but the partnership assets should be at risk, I think, first. So A and D is wrong. The personal assets, well, and it seems like to me, Linda, there are 2 problems with B. Problem number 1 is that suggests that the partnership has no liability. And also, or the other 2 partners are not parts of the members of the suit. So therefore, the answer must be C. That is, they come out to the personal assets of Ellen only after partnership assets are exhausted. Now, David, does that mean that the other 2 partners are off the hook?
Well, no, because they're part of the partnership.
Well, what about their personal assets?
Yes.
Are they off the hook? What do you think, Linda?
No, see the other one's
So the other one could do one of 2 things, Taylor. The other one could demand that the other 2 partners be brought into a lawsuit. Or 2, once the judgment, the other partner number 1 could sue partner number 2 and 3. So their partner number 1 could come after 2 and 3. As it's set up, the plaintiff cannot come after 2 and 3. Why not? Because the plaintiff did not sue 2 and 3. So, Candace, if you were advising the plaintiff, would you have advised him to sue everybody? Yes. But in this case, the plaintiff cannot collect from the partners not named, but that doesn't mean that they're off the hook because, as Linda said, the others can come after them. And then you can do number 5 by yourself. And number 6 by yourself. Sure, that's the time. So Talini, you think I skipped number 4? Alex, did you think I skipped number 4?
No, I know.
You knew I skipped number 4. Talini, this is America. Which means you don't have to be polite. Okay. To continue our discussion of partnerships, this association occurs when one partner ceases to be associated in the partnership business, allows partners to have her interest purchased by the partnership, also terminates her voting interest in the partnership, which, Linda, makes sense. If you're no longer a partner, you no longer have a vote. Things that would trigger this association is notice. David would give notice to Linda that she's out of the partnership. Or a triggering event. Kelsey, for example, we form a partnership for the purpose of achieving a certain goal, and that's achieved. Or unanimous vote. Or a court could order that the partnership be dissolved. Will somebody suggest to me why they would do that? And let's suppose that the partnership is carrying on an illegal activity. Let's suppose that we operate Linda a restaurant, and in the back room we have a room that we sell illegal drugs. Then the court could order us, as a matter of public policy, to disband. Or a partner's bankruptcy, assignment of interest, incapacity, or death. Termination of a partnership occurs in 2 stages. Dissolution is the legal death of the partnership and winding up the distribution of the assets. And legally, Kelsey, if you have a 3-person partnership and partner number 3 dies, then the partnership dies and is reborn as a 2-person partnership. So let me say that again. Alex, we have a 3-person partnership. Partner number 3 dies, so the partnership dies too, and then is reborn as a 2-person partnership. Dissolution by operation of law or judicial decree, that we can agree to dissolve. Also, by the death of a partner, the bankruptcy of a partner, the bankruptcy of a partnership, or tailoring illegal activity. Also, it could be dissolved by judicial decree by insanity of an individual partner, incapacity of an individual partner, business impracticality. Somebody give me an example of that. Yes, suppose the partnership, Alex, is formed to rent an apartment building on First Street, and the apartment building is burnt to the ground. Then therefore, it's impractical to continue. Kelsey, you agree? But now, yes, Kelsey, let us suppose, Kelsey, that the purpose of the partnership is to rent apartments. How's that different?
Because it's not just that one.
So the purpose of the first one was to rent an apartment on First Street. The purpose of the second one is to rent apartments. So therefore, once one of my buildings burns down, because we have an arsonist in town, AJ, then I can simply buy another. Improper conduct, we pay a bribe to a city official not to do a thorough arson examination, or other circumstances the partners just can't get along. They both come to class wearing red. Winding up and distribution of assets, partnership continues until so if we decide, Kelsey, if we decide that we're going to terminate the partnership, we have a vote of the partnership today. If we decide we're going to terminate the partnership, does that mean we can shut the doors this afternoon? What do you think, Julie? We have a meeting of the partnership, of the partners, and we agree that we will we will go out of business. Can we shut the doors today? Don't we have existing contracts and agreements that we have to, and we have our inventory to dispose of? So there's a period of time when it's going to take us, depending upon how complex the business is, there's a period of time, when we have to wind up. And it seems like to me a good name for this, winding up, Kelsey, would be winding up. Partners have no authority except to complete transactions already begun. Again, we've decided to terminate the partnership and collect, preserve partnership assets, discharge liabilities, and provide an accounting. Winding up, creditors get paid first, then we convert everything to cash, and then we start paying off the partners. If the liability is greater than assets, and Cody, you think that would be the case sometimes? Partners bear losses in proportion in which they share profits unless the partnership agreement says otherwise. Partnership buy-sell agreements. Contract determines in advance of any event, our remaining partners will buy out partners' interest. For example, Kelsey, we have a partnership which operates as a CPA firm, and one of the partners loses her license to practice. Then we might want to buy that partner out. Another possibility, Linda, is that a partner dies. Why is it common for a partnership tailored to have a life insurance policy on the lives of its partner when itself is a beneficiary?
They would want to buy it out before they die, otherwise after they die.
So therefore, you have a partnership. Well, I think I used this example before, Taylor. You have a partnership with Jody and Keith Harrison. You know where this is going. Keith Harrison's going to die because Jody's young, and Harrison's got at most a month left. And his children would take over his interest, but you don't want to be in partnership with his children. Therefore, you're going to buy out his children. But the problem is, Jody, that's going to take a substantial amount of cash to buy out a 1/3 partner, and therefore you're going to have life insurance payable to the partnership in the event that partner dies, so the partnership can buy out the partner's interest. Okay. And so let's look at an example of winding up. AJ and David were partners in the partnership. Partnership agreement provided all profits and losses are allocated equally. Partners, but notice, AJ, it doesn't tell you how you would split losses. Therefore, how do you split losses? If the partnership agreement does not tell you how to split losses, then you split it according to, David? The way you split profits. So let's suppose the partnership agreement does not tell you how to split profits, then you do it equally. If the partnership agreement says that 2/3 of the profits go to David and 1/3 to AJ, you agree, AJ? AJ does not agree, but that's okay. He's my hypothetical. David says, bummer. It's my hypothetical. So if the partnership agreement says David gets 2/3 and AJ gets 1/3, then how do you, but we don't say how to allocate losses, it's 2/3 and 1/3. Is that okay? Well, yeah, you want him to suffer the lion's share of the losses. Okay. Partners decided to terminate and wind up the partnership, and we have cash of $50,000, accounts receivable of $12,000, property and equipment $28,000, so total assets of $90,000. Accounts payable of $50,000. AJ has a capital account of $10,000. David has a capital account of $30,000, so the total equities of $90,000. And you notice that the debits equal the credits. And David, that would always be the case? Should be. The partnership collects $10,000 in accounts receivable and roll off the other $2,000 as uncollectible. We also sold the plant and equipment for $36,000. So how much would each partner receive? And what I'm going to do here, once I find my notes, what I'm going to do here, David, is I'm going to set up a balance sheet, and we'll go through and see what happens. So let me have a column for cash. let me have a column for other assets. Let me draw a vertical line, then have a column for accounts payable, have a column for AJ, and have a column for David. And what does that vertical line represent, David? This side should equal that side. And tell me what the numbers are. I've got total cash of $50,000. Lump in all the other assets, because I guess I could have AJ had a column for each asset, but it's just as well to lump them together because I'm going to convert everything to cash. So total other assets are 40. Accounts payable are 50. AJ, your balance is 10. And David, your capital balance is 30. So my first question is, do the debits equal the credits? And AJ, they should always equal the credits. So the first thing we're going to do is we're going to collect the accounts receivable, 10,000, which means the cash is going to go up by 10, but then accounts receivable should go down by 10 or down by 12. I get 10, I get 10, but don't we want to get them off the books?
Yes.
So they should go down by 12, which means that two things. Number one is David said we have a loss, and number two, we have an imbalance in the equation. And how do we say you would split losses? Half and half. Therefore, of the $2 loss, half of it, or one, would be allocated to AJ, and half of it, or the other one, would be allocated to David. So now, let me think about this. Now I've got a -2 here, and a -2 here, so I'm still in balance. You agree? Now, David, if you look at the previous slide, you showed the plant and equipment for how much?
36.
36. So therefore, cash is going up by 36. But the book value of that plant and equipment was 28. So therefore, that means that other assets are going to go down by 28, which means two things, David. Number one, if the book value is 28 and you sold it for 36, that means you made a profit of 8. Also, AJ, you agree? Also, AJ, I got a +8 on this side, which means I need a +8 on this side. And the partnership agreement says you split profits equally. So of that $8 profit, 4 will go to AJ, and 4 will go to Dave. You agree? Now, Alex, you're the person that we owe the accounts payable to. Do you want us to pay you? Yes, and so therefore, and when we pay you, cash is going to go down by 50. And the accounts payable are going to go down by 50. And therefore, David, I've got a -50 on both sides. So now I can simply total up the point. So in the cash, total up the columns. In the cash, I've got an ending balance of 50 plus 10 plus 36 minus 50 gives me 46. Other assets have been sold, converted into cash. Accounts payable has been eliminated. So AJ, you have 10 minus 1 plus 4, so you have an ending balance of 33.
No,
13, I'm sorry.
33.
13. And did you say all right?
No, I was like, huh?
I thought she said all right. You know what we're going to do is we're going to play back the tape and see if you said, huh? Or if you say all right. I think she said hi. Now, David, 30 minus 1 plus 4 gives you a balance of 33. And, David, I can verify that this is correct because the left hand has to equal the right hand side. So we got $46,000 in cash, of which we will pay AJ $13,000, leaving $33,000 to pay you. David, you'll find on the CPA exam that a problem like this is a fairly common problem. particularly in either in a multiple choice question or an assimilation question. It seems like David, this is his basic accounting. Questions? So let me erase this and start over. David, Megan, Linda, and Kayla formed a partnership. Partnership agreement provided profits would be allocated as follows. David 40%, Megan 30%, Linda 20%, Kayla 10%. Kayla, they don't value you much, do they? There were no express provision in the agreement for allocation of losses, which means that the losses for David would be allocated 40, 30, 20, and 10. At the end of the first year, the partnership had losses of 200. Before allocating losses, the partnership capital account balance were David 120, Megan 100, Linda 75, and Kayla 11,000. Kayla refuses, and so let me make sure I understand this. Kayla, you're a 10% partner, and the partnership had a loss of 200,000. Therefore, your share of that loss is 20. So help me with the math here. 11 minus 20 gives you a negative balance, which Linda, the partnership should be able to recover from Linda. Linda has a negative balance, therefore the partnership should be able to cover that from Linda. Or alternatively, David, continue doing business hoping that you have profits in the future. Is it common, David, that a new partnership will suffer losses in the early years? Yeah, in fact, so this is not at all surprising. What is surprising is that Kayla refuses to make any further contribution to the partnership, simply wants to be left alone to contemplate the meaning of life. So I think, Cindy, she's going to debate with Jack Winston. Okay, now, let's see what we're doing. So referring to the previous problem, after allocation, losses were allocated to the partner's capital account, all liabilities were paid, the partnership's only asset was $106,000. How much would each partner receive? So now we're going to wind up the partnership. So first thing I want to do is, Matt, first thing I want to do is I want to allocate the loss. And so we have a loss of 200. And Megan, remind me, David, remind me, you were 40,
Yes.
Megan was 30, Linda was 20, and lowly Kayla was 10%. But frankly, Kelsey, since she's unwilling to do her share, I'm not sure she's a great loss. And let them reflect, and we got this on tape, Kayla too, she said, that's okay. She's not a great loss. So now, Matt, tell me how to allocate the loss. Have a loss of 200,000, 80,000 goes against David. 60,000 goes against Megan. 40,000 goes against Linda, and 20,000 goes against Kayla. Linda, you agree?
Yeah.
So now, Matt, that gives me a balance for David of 40,000. Gives me a balance for Megan of 40 also. A balance for Linda of 35. And a balance for lowly Kayla of -9. And just to make sure, I could add these numbers together and I should get 306. I'm sorry, I should get 106. And again, 106 is the beginning capital account, total capital account minus the loss. Now, we want to wind up. So Matt, first thing we're going to do is we're going to ask Kayla to make a contribution to the business, but Kayla says no. So Matt, I need to allocate her 9,000 to the other three partners. 40%, 30%, 20%. 40, 30, and 20 is 90. 100 minus 100% total minus the bad partner's 10% leaves 90. So I can get 90 one of two ways. I've got 9,000 to allocate. Give me a way to do it.
I mean, you could go 30-30 or 40-30-30, but I feel like that'd be bad for Linda.
How about 4 nines, 3 nines, and 2 nines? And where did I get nines from? Or 40 over 90, 30 over 90, and 20 over 90. And again, where did I get the 90? Because Kayla is dropping out, so 100 minus 10. And I'm afraid, Kelsey, the math is going to be messy. So Matt, you got a calculator?
Yeah.
Take 4 ninths of 9,000. What do you get? 4,000 to be allocated to David. Now take a third of 9, what do you get? To be allocated to Megan is 3. And then take 2 ninths of 9, and that'll give you 2. And then just to keep the things in balance, I'm going to add 9 to Kayla, which gets her down to 0. Now, Matt, what is David's balance? 40 minus 4 is 36. Megan's balance is 40 minus 3 is 37. Linda's balance is 35 minus 2 is 33. And then 36 plus 37 plus 33 equals 106. Which the problem tells you is how much cash we have left. Therefore, who gets what? Kayla, you get nothing. Linda, you get 33,000. Megan gets 37,000, and David gets 36,000. Again, a simple, basic accounting equation. 2 examples of a winding up, which is a questions often encountered on the CPA exam. Questions? Alex, you agree with this methodology?
Yep.
Very good. To talk about various business forms, regular corporation, otherwise known as a C corporation. Tell me, Kelsey, why do we call a C corporation a C corporation?
Says what sections of code it's in.
The code sections of the, you remember, Sydney, in advanced tax, we looked at various code sections in the Internal Revenue Code. Section 351, Section 331, Section 337, Section 302, Section 318, and those are in subchapter C of the Internal Revenue Code, so we come to know them affectionately as C corporations. So a regular corporation must obtain a charter from the Secretary of State. Does that mean, John Kerry? Let the record reflect that half the class did not get the reference to Candace that John Kerry is the Secretary of State. Candace, I'm not referring to John Kerry. I should have asked, how many of you know who the Secretary of State is? Katie did. But then Katie's a farmer, so close to the land and so forth. But Candace, I'm not referring to the Secretary of State. I'm referring to the Secretary of State of the state of your incorporation. So must obtain a charter from the state Secretary of State. The application of the charter generally includes the name of the business, number of shares, number and types of shares authorized, the classes of stock, common, preferred class 1, preferred class 2, the purpose of the corporation, and the name of registered agent who the state can contact for information. Kelsey, which of these you think is probably the most important?
The purpose, or or shares?
I think that's very important, but I think even more important from the state standpoint is, what do you think, Brandon?
Name of the business?
Well, yeah, I think that's important, and it's important to name to give a child a name, like child number 1 and child number 2. But from the state standpoint, what do you think is the most important? Kobe?
Name of
Because we have to have somebody to contact if we want to sue the company or if we want to bring some sort of legal action against the company. And in fact, later on, Kelsey, we'll talk about if there is a defect to the articles of incorporation, that there's a major defect and there's a technical defect. This would be a major defect. Yeah. Also, a major defect, Brandon, would be not having the total number of shares because we don't know what we can issue. Advantages and disadvantages. Easy to raise capital by issuing stock, continuity of life. Alex, with a partnership or sole proprietorship, once the owner dies, the business dies. Corporation will survive. Limited liabilities. The shareholders are not personally liable for the debt or towards the corporation. And a double taxation of profits through dividends. Tax implications. Corporation is recognized as a separate taxable entity, thus will pay tax on its own profits. Losses can be carried back 2 years and offset against prior years, and forward 20 years to offset against future years. When a corporation stores profits in the form of dividends, this is considered a taxable event to the shareholders. And Alex, since the corporation cannot deduct it because it's not an expense, we have double taxation of the same income stream. Limited liability corporation, the LLC, which, Kelsey, is the way most small businesses are organized as the LLC for reasons we'll see. It's a hybrid business organization that combines the numerous non-tax advantages of corporations with a favorable tax treatment of partnerships, thus getting the best of both worlds. This is a relatively new form of business, I guess. It started in the 1990s. Kobe, is that relatively new? Started in the 1990s, so it's older than you are. But, Kelsey, in the grand scheme of the common law, which goes back to the 1600s, this is relatively new. Originated in Florida in the 1990s, and then Wyoming, and spread across all 50 states. Formation during the process is the same as for regular corporation, but generally there's less paperwork, and I think, Kobe, that makes sense because this is, although it's designed for a small business. So there should be less paperwork. Advantages and disadvantages. Not recognized in all states. Actually, I should amend that and say the rules vary significantly from state to state to state. So if Brandon, if I form a regular corporation in Delaware, then the rules for regular corporations are virtually the same throughout the country. Therefore, if I'm good in Delaware, I'll be good in Missouri. But the rules for LLCs vary dramatically from state to state, so that's a problem. Difficulty in operating in more than one state because the state law varies. Limited liabilities of shareholders, but there's no double taxation because, Cindy, the losses flow through to owners just like a partnership. So it's got the attractive, Brandon, limited liability of the corporate form, but yet the attractive tax features of the partnership. Legal liability is the same as a regular corporation, which is one of its big. Tax implications. If there's only one shareholder, it's treated the same as a sole proprietorship. If there's more than one shareholder, it's treated the same as a partnership. LLC may be required by state law to dissolve when one of the following occurs. All members agree in writing, time period passes, or an event occurs as specified in the operating agreement. A member withdraws, is voted to leave, dies, goes into bankruptcy, becomes incompetent. However, most states, including Missouri, allow the remaining members to continue in LLC if agreed upon, and if the court orders a dissolution because it's operating a drug operation in the back of Linda's restaurant. That's an LLC. An S corporation is a regular corporation that elects to be treated as a partnership. So therefore, Kelsey, this is creation of tax law. It is different from an LLC, and that is an annual election, which means that I can come, Kelsey, I can come in and out of S status. Well, the LLC status is permanent, following the requirements to be an S corporation. Unanimous vote of the shareholders. We have to have unanimous agreement to become an S corporation. Have to have less than 100 shareholders. So Kobe, that limits the amount of growth we can have. Can only have humans as shareholders, cannot have a corporate shareholder, cannot have foreigners as shareholders, and can have only one class of stock outstanding. It could have preferred stock authorized, but